After studying this module, you shall be able to, number one, understand the concept of exposure with respect to foreign exchange risk. Number two, learn about transaction exposure, translation exposure, and economic exposure. Number three, identify the management techniques for exposures. Number four, analyze how internal techniques are different from external techniques. Number five, evaluate internal techniques like netting, matching, leading and lagging, pricing policy, and asset and liability management. Now we come to the introduction part of foreign exchange risk. Every company that has exposure to foreign exchange risk must prudently manage and control its exposure together with management of other risk. Foreign exchange risk implies the exposure of a company to the potential impact of movements in foreign exchange rates. The risk that is caused by adverse fluctuations in exchange rates may result in a loss to the company. Foreign exchange risk arises mainly due to currency differences in a company's assets and liabilities and cash flow differences. Such risk continues till the foreign exchange position is settled. This risk arises because of foreign currency cash transactions, foreign exchange trading, investments denominated in foreign currencies, and investments in foreign companies. The quantum of risk is derived out by multiplying the magnitude of exchange rate changes with the size and duration of the foreign currency exposure. We shall now discuss the concept of exposure itself. Michael Adler and Bernard Dumas define exposure as the sensitivity of changes in the real domestic currency value of assets, liabilities, or operating incomes due to unanticipated change in exchange rates. Thus, as per the definition, it measures the extent to which the value of something in terms of domestic currency is changed due to unanticipated change in exchange rate. And B, it takes into account inflation adjusted value. C, it takes also a change in both stock items as well as balance sheet as well as flow items such as operating incomes. D, it exists on both domestic as well as foreign assets because unanticipated change in exchange rate can affect the value of both the domestic and foreign assets and liabilities. E, it concerns only for unanticipated changes rather than anticipated changes. As such, changes are already incorporated in the prices of assets and liabilities. Now we come to the measurement of exposure. The value of foreign currencies denominated assets and liabilities change their values because of fluctuations in foreign currencies. These changes are primarily unanticipated and it may cause by variations in short-term interest rates, inflation, tax, equity market return, expectation, etc. Change in the real domestic currency value of an item is represented by delta V, whereas spot exchange rate expressed as number of rupee per US dollar is represented by S. An unanticipated change, that is appreciation or depreciation of rupee in the value of the risk factor, is represented by delta SU. Any appreciation or depreciation of rupee has its impact on the domestic currency value of the item V, what we are actually observing nowadays in terms of rupee and dollar currency exchange rates. In other words, there is a functional relationship between delta V and delta SU. Let us estimate a regression equation considering change in domestic value of the item as dependent variable and change in the rupee dollar exchange rates as independent variables. The estimated equation may take the following form: delta V is equal to beta 0 plus beta 1 delta SU. Beta 1 is the slope coefficient indicating the sensitivity of change in the value of V to change in S. The slope or coefficient measures the exposure with respect to the corresponding exchange rate. Generally, companies are exposed to three types of foreign exchange risk. One is translation or accounting exposure, second is transaction or commitment exposure, and third is economic or operational, competitive or cash flow exposure. Here we briefly present each type of exposure, and later we will discuss different techniques to manage these risks. So let us start with the first one, that is transaction exposure, which occurs when a company trades, borrows or lends in a foreign currency or sells fixed assets of its subsidiaries in a foreign country. All these operations involve time delay between the commitment of the transaction, that is sale of an asset for example, and the receipt or delivery of the payment. During this time interval, exchange rates will most probably change and the company is exposed to a risk that could be positive or negative. Imagine the case of a local Indian importer and a foreign, let us say US supplier. If the importer pays in the currency of the supplier US dollars, then it is the importer who carries the risk, or he has to buy dollars in order to pay the supplier. Alternatively, if the importer pays in its own currency, that is Indian rupee, then the exporter is the one who carries the risk, or then it is up to him to change the Indian rupee into dollars. Usually it is the exporter to the exchange rate risk, because usually he quotes the price in the buyer's currency. Now we come to the translation exposure, the second part. Translation exposure arises from converting financial statements expressed in foreign currencies into the home currency. When a company consolidates the results of all its foreign subsidiaries, it has to present a final report to the shareholders, and the numbers in this document should be expressed in one currency. All foreign currency denominated assets and liabilities, as well as revenues and costs, have to be translated in one basic currency. Assets, liabilities and equity on a balance sheet are expressed in historical values, or actually historical costs, and the foreign exchange rate at which the currencies trade at the end of the accounting period is most probably not the same foreign exchange rate when the accounts were booked. For example, a US parent company has a wholly owned subsidiary in Australia. This subsidiary has exposed assets of Australian dollar 100 million and exposed liabilities of Australian dollar 50 million. The exchange rate declines from Australian dollar 4 per US dollar to Australian dollar 5 per US dollar. The potential foreign exchange loss on the company's exposed net assets of Australian $50 million would be US $2.5 million. In this case, net exposure Australian dollar 100 million minus Australian dollar 50 million is equal to Australian $50 million. Pre-devaluation rate Australian dollar 4 is equal to US dollar 1, Australian dollar 50 million, US dollar 12.5 million. Post devaluation rate Australian dollar 5 is equal to 1 US dollar, Australian $50 million, US dollar 10.0 million. Potential exchange loss is US dollar 2.5 million. Now you can imagine the magnitude of the risk that is involved in transactions. Third is economic exposure. Economic exposure measures the change in the present value of the firm resulting from any change in the future cash flows of the firm caused by an unexpected change in the exchange rates. Future cash flows can be divided into cash flows resulting from contractual commitments and cash flows from anticipated future transactions. In a way, economic exposure includes transaction exposure in itself. Transaction exposure is the part of economic exposure comprising future cash flows resulting from contractual commitments and denominated in foreign currency. However, we should make a clear distinction between transaction exposure and economic exposure. Transaction exposure arises from firm contractual commitment and the amounts to be paid or received are known. With economic exposure, these amounts are uncertain and based on estimates. Economic exposure can be defined as the future effect of foreign exchanges, changes on liquidity, operations, financial structure, and profit. Economic risk arises, for example, when a multinational firm incurs cost in one currency and generates sales in another. In this case, changes in foreign exchange rates affect the competitive position of the firm. Profits may decrease if the cost currency appreciates against the sales currency or it becomes more expensive to buy material and cheaper to sell finished goods, for example. This will inevitably change the expected future cash flows and thus the value of the firm, which is the present value of these cash flows. Price changes are another component of a firm's economic exposure because they affect future cash flows. Economic exposure can arise because the competitive position of a company could be affected by a given exchange rate volatility. Different factors can affect the future cash flows of a company and hence its economic exposure. The investment policy of the company or external factors such as political crisis in a country that would affect the level of sales, for example. It is difficult to identify and quantify this kind of risk as it may involve movements in currencies in which the company has no physical dealings. From a theoretical point of view, economic exposure should be the relevant exposure concept. However, it is more complex to cover economic exposure than transaction exposure. Now we see the comparisons between transaction, translation and economic exposure. Transaction exposure and translation exposure are interrelated. A company will not be able to do away with both these exposures. If it minimizes transaction exposure, then it incurs translation exposure or vice versa. For example, a parent may ask a subsidiary to bill all its payments to and receipts from the parent in parent's reporting currency. This mitigates the transaction exposure to the parent as the parent's all receipt and payments are in its reporting currency. But this increases the subsidiary's transaction exposure as the reporting currency of the subsidiary is different than the parent's reporting currency. By doing this, the parent may reduce its own translation exposure, but all its subsidiaries would incur transaction exposure. The major differences between operation or economic exposure and translation exposure are: translation exposure arises only when a firm has a foreign subsidiary or foreign operation, but economic exposure arises even when a company is purely domestic company. Economic exposure measures the impact of exchange rate on all future cash flow, while translation exposure arises only when consolidated account statements are prepared. Hence, economic exposure is a forward-looking concept, while translation exposure is backward-looking concept. That is, past performance of the subsidiary is translated as per the parent's reporting currency. Economic exposure affects actual cash flow of the company, while translation exposure results in translation gain or loss, which is a mere accounting entry. We shall now throw some light on the management of exposures through internal and external techniques. Let us see that. Risk, and in particular foreign exchange risk, can be managed in various manners. In this, we are taking about hedging the risk. A distinction between hedging techniques can be made. There are internal and external hedging techniques. The former include all the techniques that do not require external parties. External hedging techniques deal mainly with contracts such as futures, forwards, options and swaps. If the company organizes its international transactions within the company itself, it is called internal technique. It is also noted that internal techniques use methods of exposure management which are part of a firm's regulatory financial management and do not resort to special contractual relationship outside the group of company itself. These techniques aim to reduce or prevent exposed positions from arising. The main forms of internal techniques are netting, matching, pricing policies, and asset liability management, and leading and lagging. When choosing between different types of hedging, the risk manager must compare cost, taxes, effects on accounting conventions and regulation. Several objectives can be assigned to risk management. The most common ones are to minimize foreign exchange losses, to reduce the volatility of cash flows, to protect earning fluctuations, to hedge the risk irrespective of the views on foreign exchange risk. Most corporations do not use only one technique, but rather determine which technique is the most suitable for a particular case. Let us move on and discuss the internal techniques like number 1, netting. Netting is probably one of the most used methods. The idea is to reduce the number of transactions that a firm needs to make in order to cover an exposure. It requires the firm to have a centralized organization of its cash management. The centralization means that the company collects foreign currency cash flows between subsidiaries and groups them together so as an inflow offsets an outflow in the same currency. Two types of netting exist, bilateral and multilateral netting. Let us illustrate the bilateral netting with an example. Consider an Australian-based company with two subsidiaries, one in Germany and one in the USA. The German subsidiary owes the American subsidiary 20,000 euros. The American subsidiary owes the German subsidiary 30,000 euros. Netting these two flows leaves the company with a payment of 10,000 euros from the American to the German subsidiaries. Thus, the number of transactions has been reduced as well as the total amount of the exposure is also reduced. This technique is repeated for each currency to which the company is exposed. Multilateral netting is more complex but follows the same rationale. The same Australian firm opens a third subsidiary in Japan. Suppose the subsidiaries owe each other some amount as reported in the figure. When netting the payments, we obtain table. Rather than having all these transactions taking place, only the netted amounts are exchanged through a netting center as shown in the figure. Netting is an appropriate and easy to implement technique to hedge transaction exposure. Now we come to matching. Although netting and matching are terms that are frequently used interchangeably, there are distinctions. Strictly speaking, netting is a term applied to potential flows within a group of companies, whereas matching can be applied to both intra-group and third-party balancing. Matching is a mechanism whereby a company matches its foreign currency flows with its foreign currency outflows in respect of amount and approximate timing. Receipts in a particular currency are used to make payments in that currency, thereby reducing the need for a group of companies to go through the foreign exchange markets to the unmatched portion of foreign currency cash flows. The prerequisite for a matching operation is a two-way cash flow in the same foreign currency within a group of companies. This gives rise to a potential for natural matching. This should be distinguished from parallel matching, in which the matching is achieved with receipt and payment in different currencies, but these currencies are expected to move closely together near enough in parallel. An example would be currencies that adhere to a joint currency float. Of course, there is always the chance with parallel matching that the currencies concerned may move away from their previously parallel paths. In this case, the expected match fails to be realized. The practical mechanics of matching are rather like multilateral netting, since it involves the group treasury and gives rise to the need for information centralization with the group finance function just before settlement. Practical problems may arise because of the uncertain timing of third-party receipts and payments. Unexpected delays can create problems for the multinational treasury in its endeavors to match receipts and payments. There are obvious difficulties in the possibility that receipt of a sum due on a certain settlement day is postponed, but payment is nonetheless made on that same date as originally anticipated. For this reason, success in matching is very much a function of the quality of information coming to the corporate financial center, including realistic and accurate predictions of settlement dates. Like netting, the extent of matching is constrained by the exchange controls of some countries. Now we come to leading and lagging. Leading and lagging are carried out to adjust the timing of receipts and payments. Leading is making a payment early, while lagging is delaying the payment. Leading and lagging are best suited to the intercompany settlement environment rather than for dealing with third parties. It enables a group to manage both its cash positions and its currency exposures in such a way as to benefit from offsetting positions within the group. Leading and lagging can enable a group to adjust the timing of currency flows to eliminate unnecessary dealing to take advantage of expected currency movements. Example, subsidiary X owes subsidiary Y $1 million, payable on 30th June. Subsidiary Z owes subsidiary X $1 million, payable on 31st July. Subsidiary X either obtains agreement from subsidiary Y to delay payment until 31st July or requests subsidiary Z to pay 1 month early on 30th June. Alternatively, a compromise could be reached with payments being made at some point between these two dates so that Y and Z share the disadvantage. The result of leading and lagging is that internal sources of currency have been used and settlement has been made without the need to enter into foreign exchange contracts. Where its base currency is weak, the company would seek to lead its foreign currency payments and lag its foreign currency receipts. If its base currency is strong, however, it would take the opposite approach. The aim is to maximize assets in strong currencies and minimize liabilities in weaker currencies. Leading and lagging is only really appropriate where there is a reasonable volume of intercompany cross-border trade and where there are no governmental or regulatory restrictions, because leading and lagging can become complex and because it is essentially carried out to obtain a group benefit. There is a strong argument for a central treasury to be responsible for implementing and controlling it. Where there is a local minority interest, it may not be possible to lead and lag if local costs are incurred in order to achieve a group benefit. Now we come to pricing policy. Price adjustment can be made in different manners. First, when the local currency of a subsidiary is devaluating, the subsidiary can increase the price so as to cancel the effect of devaluation. This technique is particularly used in countries where devaluation is high and where derivative markets are inefficient. On the side of disadvantages, the difficult implementation of this method needs to be signaled. Prices cannot be raised without any consideration about competitors, because if the price increases too much, the customer will choose an equivalent and cheaper product from a competitor. In the same logic, a firm can increase the export price, but then the price adjustment is even more complex, since the company has to face not only local but also international competitors. Second, the company can change the currency of billing. Third, the firm can use export currency of billing to transfer profits from one affiliate to another. The purpose is to raise or lower intergroup selling prices by billing rate adjustment so that profits appear in hard currency or low tax companies. This technique is very aggressive and can be forbidden by regulation. Asset and liability management. This is another internal technique to manage unfavorable change in the exchange rate in the future. Asset and liability management technique can be used to manage balance sheet, income statement, and cash flow exposures. It can also be used aggressively or defensively. The aggressive approach reflects to increase exposed assets, revenues, and cash inflows denominated in strong currencies and to increase exposed liabilities, expenses, and cash outflows in weak currencies. The defensive firm will seek to minimize foreign exchange gains and losses by matching the currency denomination of assets, liabilities, revenues, expenses, and the cash inflows and outflows, irrespective of the distinction between strong and weak currencies. To achieve these objectives, variables are grouped. Operating variables includes trade receivables and payables, inventory and fixed assets, and financial variables, cash, short-term investments, and debt. The currency denomination of operating variables is determined by intrinsic business conditions, production, and marketing factors. Financial variables can be used for exposure management purpose, and thus corporate financial management has more discretion over currency denomination. The paucity of currency finance is often a major problem. The parent company would borrow the weak currency from long term, while the subsidiary is usually limited to short term borrowings. This is because A. Most subsidiaries are not individually listed on a stock exchange, so that the public issue of debt instruments is very difficult. Hence, the substance of long-term loans taken out by foreign subsidiaries are private placements. B. Many foreign subsidiaries are relatively small and not well known to the local financial community. And C, host governments may be reluctant to allow term borrowing by expatriate subsidiaries. We shall now recapitulate what we have learned so far. Number one, foreign exchange risk implies the exposure of a company to the potential impact of movements in a foreign exchange rates. Foreign exchange risk arises mainly due to currency differences in a company's assets and liabilities and cash flow differences. Exposure has been defined as the sensitivity of changes in the real domestic currency value of assets, liabilities, or operating incomes due to unanticipated change in exchange rates. Number three, actual exposure exists when a currency receipt or payment that will definitely take place because it results from a firm order or sale for which an invoice or other documentation has been issued. Number four, exposure has been measured as a slope of regression line which sensitive due to unanticipated change in exchange rates. Transaction exposure, the risk that the base currency value of a foreign currency denominated trading transaction will vary as a result of changes in exchange rates, giving rise to an increase or decrease in reported profits. Translation exposure, the risk that when translated at the foreign exchange rates which will apply at a future balance sheet date, the domestic or base currency values of assets and liabilities on the balance sheet will alter, resulting in a reported gain or loss. Economic exposure. Economic exposure measures the change in the present value of the firm resulting from any change in the future cash flows of the firm caused by an unexpected change in the exchange rates. Economic risk arises when a multinational firm incurs cost in one currency and generates sales in another currency. Exposure management is the process of minimizing the financial effects of changes in the exchange rates by using internal and external hedging techniques. Forecast exposure is also known as uncommitted exposure, a currency exposure which is expected to arise based on reasonable forecast of future trading patterns. Internal techniques of exposure management are those that do not resort to special contractual relationships outside the group of companies concerned. Such techniques include netting, matching, leading and lagging, pricing policies, and asset liability management. External techniques of exposure management are those that resort to special contractual relationships outside the group of companies concerned. Such techniques include derivatives like forward, futures, options, and swaps. Netting involves associated companies with debts, possibly as a result of trade with each other. Associate companies simply cancel out amounts owed with amounts due and settle for the difference. At its simplest level, there is bilateral netting. At a more sophisticated level, we have multilateral netting. Either way, the group treasury plays an active part in coordinating settlement payments between associated companies. Netting reduces banking costs. It has been estimated that savings of approximately 1/6 of 1% of the flows estimated are likely to accrue from netting. Matching is a term applied to a similar technique which involves not just affiliates but also third parties. Leading and lagging are techniques that are resorted to in the light of expected devaluations or revaluations. These mechanisms simply involve making an advance payment or delaying payment on amounts due and denominated in foreign currency. The basic idea is to reduce the amount of local currency needed to settle a debt. It should be noted that it is necessary to take into account the effects of interest payments, receipts when considering the implementation of a leading or lagging tactic. Pricing policy used as an exposure management technique simply involves increasing prices to allow for expected changes in exchange rates or invoicing in a particular currency to reduce the risk associated with invoicing in the host currency when devaluation is expected. Asset and liability management used in the context of exposure management involves manipulation of operating or financial variables to balance the currency of payments with the currency of inflows.